Anil Rego of Right Horizons, who's joining in to talk about the themes that we should be watching out for and what a new investor looking to invest in the markets do at the current juncture. Good morning, Anil. Great to have you on the show. My first question to you is, markets are, of course, rubbing shoulders with record highs. We've seen a dream run since March 28. Do you think it's a good time for a new investor to enter into the markets, given the fact that, valuations, of course, are looking pretty much higher than what they were a few months ago?
Yeah, definitely. I think maybe a few months ago would always have been a better time, but some of this is at hindsight, right? So, new investors, maybe end of March, there was sufficient reasons for volatility. You had this whole SVB crisis happening, and it was spreading to Europe. Credit Suisse also was under pressure. So in that standpoint, in fact, that's where actually you find bottoms. And for us, like as contrarian investors, maybe we would come in there. But unfortunately for a common investor, those are nervous times, and when there's a little bit more stability is when they sort of tend to enter and they prefer to enter. Now, coming back to your question of should a new investor even look at the markets right now? Again, I'll step back and say, while we see markets at all-time high, you need to keep it from the perspective of this is the same value that we saw in October of 21, right? So it's been a reasonable period of time where the index has actually not broken out. In that period, we saw earnings grow. And to that extent, I would say there's what I would call is a time correction, even if you didn't find the index go to, new highs. So from that perspective, I still think we are early enough. And typically, I mean, experience shows that once sometimes the breakout happens, then you may just see a quick spurt and, then further moves happen from there in a larger way. So that's what I think will happen. I don't think it's a really short-term orientation there, and one believes that there's more steam left. So investors who are coming afresh, yes, maybe they can invest, but just be a little cautious because yes, market has already moved some bit. Maybe some of them can do systematic investments or phased investments. Be careful, diversify. Keep a few fundamental, basic investing principles in mind while you invest.
Right. Keep the fundamental principles in mind and exercise caution at these levels. But if I were to ask you, which are the themes one should look at now? Should one hunt for value or chase growth at this juncture?
See, India has been always a growth market because it's an emerging economy and there is growth in it. So what I would say is the more difficult one, maybe growth at a price, right? In fact, that's been our philosophy as well. So how do you find companies maybe which are growing well? You see good earnings growth, maybe even a doubling of earnings growth over the next 3 to 5 years, and then you also, on the other hand, find them say at a discount to the valuation of the sector. I think those are ones which can be emerging leaders, and work hard to try and identify some of them, and those are the things stocks to invest into.
Right. This is a time, Anil, when global economies are actually staring at a recession, and some of them have, in fact, even slipped into one. But, then on the other hand, US tech companies are spending big on generative AI. Do you think this is a good time to play this theme or this revolution, if I may call it so, and take exposure to stocks that are leading this revolution, so to say, the likes of Nvidia, Microsoft, and the likes?
See, I would be a little cautious from a standpoint of two reasons. One is, the Nasdaq was a leader of, say, the last bull run in the US, and that is at a high, a multi-year high. It's gone up many times over. So from that standpoint, I would still be a little more cautious in terms of investing while, we are already in a large market move. Yes, there's been a correction, but history has shown that whenever the turn happens, it's really painful, and the percentages on the negative side are very large. So I'm just saying that there I'm not so comfortable because there's a very, very large move that has already happened. The second point is about generative AI. I think some of these disruptive technologies, you don't know which way it will go, right? And how quickly, the move is happening, where you could even have new incumbents coming in. You could have, somebody else just come in from under and, make it very different and or difficult even for some of the larger companies because of the way the disruption is happening. So at this point of time, I would say yes, maybe invest into the team for a part of it, but don't go overboard.
All right, don't go overboard when it comes to the AI theme. I also want to ask you, if somebody wants to invest a total sum of somewhere around 10 lakh rupees today, how should one go about allocating investments between different asset classes, and what should the ratio be like?
Yeah, very difficult to give a generic, view on that because everyone has a different risk profile. So the first part is, to step back and see what is your risk profile and decide on how much of debt and how much of equity, right? Some thumb rules people use based on age, 100 minus your age. If you want to be a little more conservative, maybe, you can do 80 minus your age, etc. But broadly, you have to see what is it that you're comfortable with, and if markets fall, are you comfortable in managing your monthly expenses and everything? You should not suddenly, feel pressured because markets are falling and you don't have liquidity out there. So those keeping in mind, I think, let's say for say a 40-year-old, maybe you can actually look at up to a 60% of equity allocation at this point of time. Be reasonably diversified. If you are a person who knows markets and understand, able to track, then directly invest in stocks. Otherwise, I'd probably just stay with, doing systematic transfers or systematic investments, into equities. It could even be, systematic transfers on a weekly basis. I would believe it's good to be slightly quicker in deployment right now, but be a little diversified. Again, within, say, market cap sizes, our view was that, and is that we think mid and small caps will do well, in this next maybe year or two. So that is where we think more of the action will come in. Even though there's a little bit of a move, I think small caps still, if I look at long term, valuations, we are still at a discount versus that. We are a little away from even the peak in terms of the small cap index. So that is something which, I would do, but keep in mind that it's the most volatile, right? So compared to all. So in this, let's say 60 that you have on the equity side, I would say keep aside maybe 20 or 15, depending on one's risk appetite, to say mid and small caps, and then, spread it out over maybe large and some of them also, somewhere the mid caps, and, play your themes accordingly.
All right. So that's the kind of, portfolio mix one should have. With that, Anil, thanks a lot for taking out time and joining in this morning. It was a pleasure speaking to you.